listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to another episode of the Daily Gold Podcast. Been looking forward to this for the last couple days. With me, returning guest, Vince Lanci. You know him from Echo Bay Futures, writes the Gold Fix, does fantastic work. Love having him on. Vince, I know there's multiple things you want to talk about. You're kind of tight on time today, so let's get right into it. What's the first thing? I mean, I want to get you touching on what you think's driving this move in gold. I mean, I can speak more on the technicals, but right. What's driving this move? I mean, what's the first thing that you want to talk about?
Okay, so just to list it like a laundry list, not to get into it because I'll get all like philosophical and hippie, and we're not looking to do that today, I don't think. Look, you've got a combination of things that are out there, and those things are, in no particular order, the Ukraine war, the Middle East war, the de-dollarization as manifesting in people selling their treasuries. These are all fundamental, secular, macro, however you want to talk about it. It's not technical, but it's going to show up in technicals. Those things are happening. Additionally, and not being talked about, being forgotten about, and I think is very important, or will grow in importance, is that you have a government shutdown deadline of November 17th. We all forgot about that. I mean, I don't know if you forgot about it, but it's pretty forgetful when all this other stuff is going on, and they can't even decide on who the Speaker of the House is. Anyway, so there's all that, right? There's an increasing awareness of the BRICS behavior with regards to things like the difference between Shanghai and U.S. gold prices. You've just got a lot of geopolitical open wounds out there now, and everyone's not the right word, but most of us, let's pretend that we're all non-believers, right? What's new, Vince? Nothing's new. This happens all the time. I'm like, yeah, it does, but this time the market's moving while it's happening, as opposed to moving before or moving after. We're getting slammed as soon as the big news comes out. We have a tsunami of unfinished business that's underpinning this market. Now, I personally think, before we move to the technicals and to the charting, I personally think that for every dollar of treasuries that's being sold, 10 cents is being put into gold. Not gold futures, gold physically. And eventually, the futures players are now biting at this as well. Finally, to get it over with, you and I have talked about this a couple times last year as well. There's a seasonality to gold, aside from fundamental seasonality, meaning Diwali and weddings and things like that. There's an investment seasonality to gold that I've been talking about publicly since 20 or 21. And that seasonality goes like this, in the short version. Between August and the end of October, the market makes a low. And that low is made as funds, macro, long-only type funds, liquidate. And during that liquidation phase, gradually, you start to see CTAs chase momentum lower and get short. And when that sell season, I call, is over, you get a reversal, usually around Thanksgiving, U.S. Thanksgiving, and the market rallies because the selling is done, and banks are now putting out their recommendations for the next year. That's what's going on. We are in the corridor between sell season and buy season, but that corridor seems to be very short this year. So what are we up, $200 off the lows? That's it. That's what's going on before we get into the important stuff like price.
I want to follow up on treasuries in the bond market. I mean, sure. For me, because we know the 10-year yield, it broke out a month ago or so, something like that. We know that, I mean, it's been rising for a little while. It's come out of that brief consolidation. But for me, I see, I mean, the yield curve has been steepening. It's getting really close to zero and going above zero, where that indicates a recession. I think in the last week or so, that has something to do with it, that there's some kind, I don't want to say an inflection point, but in the last couple weeks, maybe the 10-year bond yield, rising, getting closer to 5%, and the yield curve steepening, getting closer to zero. To me, that maybe there's been some kind of a bit of an inflection point there where the market is sensing, if this shit keeps going, this is going to cause a recession. And it's getting really, close where you can't deny that. And maybe that has brought some buying into gold recently. I mean, that's my macro analysis, but I know you look at way more factors than that, but I just want to get your thoughts on like how or why or if the sudden rise in the 10-year yield has become immediately bullish for gold.
Right. Okay. All right. You touch on, I think, a really important point, and that is from a macroeconomics perspective, right? Which is how most people think, and I think that way as well. From a macroeconomics perspective, just simply put, we're not talking about the bonds yet. We will get to that. From a macroeconomic perspective, simply put, a recession is bearish for gold. From a macroeconomic perspective, simply put, rising real rates as well, is bearish for gold for the old reasons that happen to be true. If you can get 5% on your money, 4% of that is real. It's not, but I'm just saying that's the number. 4% is real. Then that becomes an opportunity cost, something that you would compete with your desire to put money in gold. Therefore, in a recessionary environment, typically for behavioral purposes, interest rates go up. Well, forget about what caused the interest rates to go up first. That's the first thing that we have to think about. But just statistically, if interest rates go up, people are more likely to eventually put their money into bonds or at least money markets, and the stock market and gold and oil all come off. That's your normal cyclical, recessionary, macroeconomic analysis, and it's tried and true. What's different, there are two things different. One is narrative, I'm going to tell you, and the other is factual. The narrative one is this. Yes, Vince, all those things are true that you're saying. However, we have a conflict, and that conflict is that even though your macroeconomic commentary is tried and true, there is a bigger secular change in the marketplace, and that secular change is reflected or represented by Chinese buying gold, Chinese selling treasuries, the Fed staying at high rates, not because we're killing inflation, but because we're still chasing inflation. So that's the narrative. And that narrative is at war, is really taking hold now. And it's at war with the macro story. The macro story is gold's eventually going to come off because rates are this high. That's tried and true, right? So why are rates, the correlation of rates to gold, why are they so broken? And you can see it in the dollar as well. The dollar's strong, gold is strong. Okay, maybe that's because of the war. The dollar's weak, gold is strong. Okay, that's because the dollar's weak. Like every reason for the last 2 weeks has driven gold higher. And that's the narrative, right? So now you have your competing narratives, tried and true macro versus this secular tailwind story that you and I have talked about before. The real thing that you can see that's entirely different, and not many people are going to talk about it, and we're not going to talk about it much now, but interest rates are going up at the long end, as you know, the 10-year bond, the 20-year bond, the 30-year bond. This is not the Fed raising rates. This is a market, and you use the term steepening, right? So for people that aren't bond people, commodity people would say this curve is going flat. So the interest rate was, let's say, 5.25% by Fed funds, and the 30-year was 2%. Well, now the interest rate at the Fed funds level is 5.25%, but the 30-year is 5%. So as the curve flattens, you correctly note that you are likely headed to an economic recession. Now, that is probably true. The thing is, how we're getting to flat is very dangerous. And if you look at the curve, I'll just try and explain this very simply because it is kind of technical analysis style. If the curve is split into two parts, the front part, the short end, and the long part, Just looking at that. Fed funds rate and 30-year bonds, right? 10-year acts like the 30-year. Well, if the Fed funds rate goes up, that's the government saying that inflation is not a big deal. We're fighting it because the back end bond rate is staying down. The long-term perspective is saying inflation is not a big problem. He's going to raise rates. We'll have a recession. It'll be over. Okay. But when the Fed doesn't raise front rates anymore, whether you think they should or not is not the point. The market starts to raise back end rates. The market is telling you the Fed hasn't raised short end rates enough. Fundamentally, inflation is going to be with us a lot longer time, and we must fight it. I'm telling you, those are facts. That's how it works. So if the curve goes flat at 1%, that's 1% inflation 30 years out. If the curve goes flat at 5%, that ain't 2% inflation 30 years out. That's a big deal. Now, if gold is looking at that the way I think it is, that's why people are buying it, because they're saying, hey, inflation may be getting under control short term, but long-term manifestation of it will be here. And that is also evidenced, even though it's not technically inflation, in China selling its treasuries. That's it. That's me just dumping it out there. So I think macro is fighting fundamentals right now, or secular. That's it.
So now there's a million things I could follow up with. Not a million things, but a couple things.
You want to get into technicals?
Yeah, let's that's good. Let's get into technicals.
Right? Because we're going to go down rabbit holes if we start doing this stuff.
Right. Yeah. We could come back to fundamentals if something pops in our head.
Yeah. We'll do it. We could talk about it on a mob show, something like that. One of the mob movies. All right. I'm plugging that. So what do you see?
Do you want to talk about the triple top first, or?
Well, I think this is like you, man, right? We'll get to the triple top, but what do you think? I'm asking you, I'm interviewing you now. What do you think?
Well, I think, looking at, there's a saying that a lot of technicians have that from false moves come fast moves, and the breakdown below 1900 looks to be a false breakdown. And you've been in this market for decades, so you know that
right.
there's so many false moves in precious metals,
right.
and if you're just looking at gold specifically. So for me, the break below 1900, that was a clear breakdown, but
right.
That looks like a false breakdown to me.
Because I'm sorry. I want to ask you this, like as a student, right? What are some of the characteristics of what appears to be a false breakdown? Because I didn't see that at all. I don't see anything.
Okay. Essentially, I'm looking at a weekly chart. Essentially, a false breakdown is when a market breaks down below a certain support level, and then the market, the first order thinking is, which is right in the vast majority of the time, this is a technical breakdown. The sellers are it's broken down below a key level. The sellers are going to get, they're going to gain a lot more control. This is very bearish for the market. Now you have a false breakdown when it quickly after that happens. I don't know the timing exactly. If you're, it shouldn't
depends on the market.
Yeah, it shouldn't take more than like a week or two, really, or even like a couple days, depending on the market.
Right.
But you get a reversal and then a really sharp rebound in the other direction. So it's not just like we put in a bottom, we got a reversal, we got a little bit of a rally. No, it's like you get a big rally and it keeps going.
Right.
Now, as far as how high, I'm not sure as far as how high or how soon the market has to recapture that level. But if you're looking at the daily chart of gold, like a daily candle chart, you can see how this was a false breakdown. Like you can draw a trend line, not even 1900, but right around, 1910, 1915, somewhere around there. It was a clear breakdown. We had strong selling. Then it looks like, I think it was October 8th or October 9th.
Right.
You had a bullish intraday reversal where, gold opened up, in the 1830s, traded all the way down to 1823, made a new low, and then it
I got that. I'm looking at it now.
Yeah, vaulted higher intraday, and then the next day you had a gap up, and that gap still held. And so the market rallied for a couple more days. Then you had the big explosion from last week. So this is a clear false break. And so that's the point. Like, you need the fast move on the other side for it to be a false breakdown.
So it needs to be a rejection. It needs to be a rejection. Okay. So I want to add something to that, because as you were going through it, I was following on the chart, and I want to add some things that have nothing to do with what you said, but strangely mirror it. And on Sundays, GoldFix, we do a founders class, and that's basically for some of the premium guys. And we were talking about, we look at the commitment of traders reports, and that's how we focus. But I remember looking at the daily and saying to everyone, if you look at gold, it's in a we're looking at it, say, September 26th, right? That was like the last day that we closed in that above 1915, right? Before the sell-off on the daily. And I was saying to them, look, this is a big channel with a bottom of 1915-ish and a top of 2008, made in the 31st of July, I think, right? So you have this back and forth seesaw. And then what happened the next week? And I'm saying this in such detail because it corroborates your comment of it being a false breakdown. And here's what happened. After we broke 1920 on September 26th, and then we came in lower on the 27th, we had already done the analysis on this. And what I had said was, on the Monday of that week, whatever that was, I said, or Sunday night, I said, I would be surprised if this market does not come in lower. And the reason I said that was because, number one, silver had that horrible wick. Remember that wick on the daily? And number two, this goes to your point. Number two, I know who sold that. The breakdown below that bottom of 1915 or so, that was sold by the CTAs and the small funds. How do I know that? Because the data shows that to me. And then the CTA data showed that to me. So it's a COT and a CTA data. And this is key, it's sell season, which means the selling that's coming out of the big boys is not selling getting short. It's selling getting out of longs, and it will dry up. And then after the market made its lows, and I did get long down there after the turn. I didn't keep it long, but I got long. What we noticed was we had a day, and this is technical, even though I don't call it technical. This has to be technical. October 5th, maybe, where the market made a new low. It's right before the day where it made the disastrous low and then bounced hard. On October 5th, it made a new low and open interest went up. And that meant someone bought the dip hard. And the shorts that sold were selling to banks. So in combination, we concluded as a group, we concluded that this was either a very serious pause or a reversal. So we took it as a small reversal and figured it would rally a little bit and then just bounce and then just get hit again. But it didn't, to your point. So that's what do you call it? A false breakdown?
A false breakdown.
Yeah. So It's kind of like the opposite of a false bottom, right?
Right.
You know, false bottom, you keep going. Yeah. That's great. Yeah, this is what happens.
But you have the fast move on the other side. And so that's going from 18, I mean, intraday, 1823, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I mean, all the way up to, I mean, what was the high today? Almost in the 1990s.
You're looking at spot, right? Futures.
I'm looking at the continuous, actually.
All right. Well, futures. The futures high was 2009, 2009 spot 20. Spot went to 1997 spot 23. So 1997 and change.
And I have a couple other points if you want to.
Yeah, no, that's great. But this is good because you identified a false breakdown. It's a big reversal near the bottom. But what you said, it was the speed that mattered so much, and that's right.
You get a strong move on the other side.
Yeah,
you see it. I mean, you see it in the other I mean, we've seen this in gold many times. Well, on the other side, when it's like you break, it's like, gold or silver. It's breaking above a certain level, and then it's like, whoop, then you get the flush. Like usually that's the way it happens.
So the false breakout higher is what we normally get, and now we're getting a false breakdown, which is kind of a sign of a bull market, I guess. I mean, that's how you got to look at it, right?
Yeah, and the other thing, I love using the 40-month moving average. I mean, we're getting into really long term, but if you look at the last 40 years of gold on a monthly chart,
right,
the 40-month moving average has been an incredible indicator. And just to go back a little while, the 2008, when gold went from 1,000 to 700, basically, it bottomed at the 40-month moving average.
Right.
2019, that low, I think in April, or looking at in April or May, before the Fed signaled it was going to cut, gold came down and bottomed at that moving average. And this bottom happened basically at the 40-month moving average.
Did it really?
Yeah, it's pretty clear.
I don't have it in front of me. I'm just looking at it saying, wow, that thing is really traversed.
The 40-month is at 1852. And if you look at where gold, but gold opened at 1864. But if you're looking at a monthly candle chart, you can see that, it went below. Yeah, it went below the moving average, but
it didn't settle below.
You're right. It didn't settle or close below. So, I mean, that's another thing that's really interesting. And then we can get into the other thing is, I mean, the last time we talked, I mean, I can't remember. I think we were talking about 1985 and 2000 on the weekly. Well, 2000 is 2000's resistance on the monthly. Maybe did we close above that by like $1 at one point? You'd have to look at your
hold on. Yeah, I'm an idiot. I gave you the chart. No, let me find it. I have it.
I can pull up the chart.
You pull up the chart, I'll see what I got.
Okay. But my point is 2000 is it's monthly and weekly resistance. Oh yeah, so gold closed at 2009 on the continuous in July. 2009. Okay. But I mean, that's you could almost still say 2000 because that's less than 0.5% closing above it. That's not a real breakout.
I see what you're saying. So
I mean, we could call it 2010 but just to make it simple, if you're looking at the monthly chart, 2000 is clearly resistance, all-time monthly closing high 2009, but on the weekly chart as well. So there's been 2 weekly closes, I think at 2024, 2025. But if we're looking at a weekly candle chart, it's clear that 2000 is also significant weekly resistance, especially because if we get back above it, then we're back above, the June, July, where the market failed, it had that bounce after the first sell. So we're coming up on the monthly close, 2000 on the weekly. So I guess that's just my point is over the next 7 to 10 days, that's the 2000 is going to be the key resistance level to watch.
Right. So I'm just trying to recall our conversation about this before. We were talking a couple of months ago about the highest close on a month, and that being a highest all-time close. And what you're saying now is it was the highest all-time close, but it didn't penetrate it enough to, let's say, clear the area. And so that makes 2000 the area we care about again. Jesus.
Yes.
It's always 2000. Look at all those wicks.
Yeah, you're looking at the monthly. Yeah.
No,
that's what gold is, and we've had a really good rally, which is a good sign. But to me, if gold corrects or consolidates for a couple months here, I mean that wouldn't dissuade me that much.
I would love that. I would love that because if it goes parabolic tomorrow, it's like attracting attention. It's just like, oh, it's in the headlines. We can't let that happen. Murphy's Law. But if it just bases here, I mean, we just withstood some serious selling for a long, protracted period of time.
Yeah.
I mean, sideways is good. Sideways is good now because let everyone forget about it. Nothing's resolved. Nothing's resolved. Anyway, so, let's talk triple tops, right? Everyone's got an opinion on that, but you and I have the right opinion. We do. We just do. All right, I want to good.
A triple top, I mean, for it to be significant, you really need it to be a reversal pattern. So when I think of like a legit triple top, I think of a head and shoulders top.
Okay.
Now,
right.
for head and shoulder, like one thing about head and shoulders patterns is you really need. There are some that are continuation, but for a head and shoulders top, you really need there to be a strong move higher, maybe even for like a number of years to set up the reversal. So like, if a market goes up a little bit and then it's like, oh shit, this is a huge head and shoulders top. Like, no, right. It isn't, because there's not enough. The trend has not been in place long enough to attract enough buying and all that money that is needed to set up this massive topping pattern and then this huge breakdown that comes on the other side. So, when we're looking at, pulling up a monthly chart of gold, like yes, it went up from 2018 to 2020, but that's not really, there wasn't enough there to make this like some huge distribution pattern.
I was going to say, this is right.
And just sorry to interrupt, because
no, I'm interrupting.
Forget before so when you think about a head and shoulders top, you have one high on the left, and then the middle is the highest, and then on the right you have a lower high. Mm-hmm. So, that's how these distribution patterns tend to look. And so when you look at gold, looking at gold on a monthly chart, that's not what you have. Okay. You have one high, and then actually in 2022, that's actually a bit of a lower high. And then on this side, gold, there's all those wicks up there by 2000, but the weekly and monthly closes were higher.
Right. Exactly. Yeah.
Were higher than what happened in 2022. So I would be a lot more concerned if the 20, like, for example, okay, so in 2020, let's just say the peak was 2000. We're looking at the monthly. I'd be more concerned if the peak on the Russian news or Russian invasion was 2100 or 2150, and then the high earlier this spring was, let's say it was 1920 or 1950.
Right.
Then that would kind of look like a head and shoulders, and you'd have to look and say, okay, well, this market, it's
right. I see what you're saying.
The head is the highest. So right. That's a head and shoulders in a distribution. I know this stuff is technical, and I'm not doing the best job explaining it, but for anyone who's looked at, who's been looking at charts every day for 20 plus years, mm-hmm. They can look at gold and they know instantly that's not a triple top. Like, there's not distribution there. This is not some massive topping reversal pattern. So people who say it's a triple top, they're just pointing out, like, yeah, I see three tops. But for it to be a triple top pattern, you have to have this huge preceding uptrend and this period where the top forms and it's clear that there's distribution there.
Okay, gotcha. So I looking at it like through your lens, you're basically saying, hey, look at the high we had when the Russian war started, and look at the high we had earlier this year. Well, guess what? The high we had earlier this year was higher than the Russian war. So we've got a higher high on ostensibly less bullish news. So this market's not done rallying. Meaning, it's not a head and shoulders. The head's not pronouncedly higher volume, and the second high is lower. I'm not even looking at the left shoulder. You know what I mean? But I think I'm agreeing with you. So basically, let me see if I understand this, because I want to say something that was said to me by a real technician before both our times. You don't put a lot of, if I'm doing you justice. You don't put a lot of weight in triple top formations to begin with, because they look like bad versions of head and shoulders. And head and shoulders and other longer term distribution type of exhaustion tops that happen in threes, those seem to be more reliable. This does not seem to be like that, not to mention because of the way the highs are structured, but because of the duration spent there, there's not a lot of distribution. Is that what you're saying? Something like that?
Yes. And that there's not, for there to be this massive top where gold's going to have this big move down below 1600, there's not enough of a preceding uptrend.
No.
It went up for basically, 2 years, 80% or 70%, whatever it was, August of 18 to August of 20.
Mm-hmm.
That's not enough for there to be a distribution pattern. And like when you back out and you look at, like I'm looking at it, since 2009, that's a cup and handle pattern. I mean, we can get more into that because I know some people don't think it is, but this is a very strong cup and handle pattern. Like there's reasons behind that. And that's not just me being a gold bull.
Tell me, I want to hear
it. But that's the point I want to make, because when you, and this is why, a lot of time you have to like really zoom out and look at as much history as you can. And so if you're looking at, 12 or 15 years, it's clear this is a cup and handle pattern. Like this is not a triple top. And, confirmation of that is the fact that, after which we already said, after the 22 peak, gold even rallied all the way back to the high and went a little bit above the 22 high. And what we've seen in the last 4, 5, 6 months where you had this correction and now gold has vaulted back up to almost 2000. And so it's when gold on the daily chart, climbs back to 2050, it's going, I mean, everyone's going to know. They're already pretty close to knowing at this point, but they're going to know like, holy shit, this is about to break out.
Right. Okay. So we talked about this again before, and to bring it up again, because it hasn't changed. There are people in the market, big players. I'm not saying they're smart. I'm saying big players that are looking to buy new highs. They made that statement 1, 2, 3, 4 months ago, which was when we had that high close. And those people have said to their advisors at the bigger banks, hey, I have interest in gold, but I'm not a dip buyer. I'll buy it above new highs, because if it gets above new highs this time, I don't think it comes back. Now, it doesn't mean they're right, but it does mean that there are buy stops above this market right there, which leads me to believe that the market will trade to those buy stops. What it does after that, we don't know. But this market, this triple top concept is nonsense. And just to add something to the triple top thing, because I think this is helpful, because this is how it was described to me. The cliche was triples don't exist. And the statement to the effect was triple tops are made to be broken. Triple bottoms are made to be broken. And I asked why to the old man before I became an old man. And he said, well, he explained it to me in flows. And when you hear it in flows, you understand why the technical analysis is so good on it. A market makes a high. It rejects it. Somebody sold it. So let's pretend that the market makes a high and there's a really big, massive seller, and then the market runs away from it. The second time up to that area, the market tests that high again, but now you've got two sellers, the original seller, and now you've got the copycats. So now you've got people who say it was there before, right? The first seller is not a technical seller. The first seller is a guy saying, that's a good price, sell $1 billion. The market runs away from it. The second time up, you've got the guy who wants to sell $1 billion, plus copycat technical traders going, oh, it stopped there before, it'll stop there again. That's your double top. Double tops are extremely strong. But when a double top is retested and becomes a triple top, that means you now have two nibbles at that original order. The first time it went up, the big order, some of it was taken out and the market ran away. Second time it was up, the big order, the third time up, some of it was taken away. So now you've got 3 bites at that apple. Now, does it mean it goes up? No, it means if there's a fourth top, it will not hold. That order, if it's still there, will not be there this time. And the only people that'll be there selling will be the copycats who think it's still there. So the old man said to me, triple tops are made to be broken because there's too many people leaning on that one big order. and they get crushed. If it goes back up there, they get crushed. They don't become four tops. There's no four tops. That's basically what he said to me, which is consistent with what you're saying. It's not a distribution, right? It's not a distribution. Anyway, so that's my take.
Right. And I'm sure he probably also explained how a distribution top, you have the original sellers, and then you have copycat sellers, and then there's probably, more.
Right. Well, he didn't use the word distribution then. He said, this is what he said. In fact, he actually said what you're saying in different ways. He said, when a market rejects a level violently and then comes back up and rejects it again and doesn't spend a lot of time, to use his phrase, dicking around up there, that means that order is either not filled or he went hard to the market. The next time up, he's not going to be there. So the point is, it's not the market. Here's what I'll say. The market didn't spend a lot of time there allowing people to get long. It ran away really quickly. People got hurt, but a lot of people didn't pile in to get hurt. That's it. So you're right. I agree with you.
So the real key point here is the fact that after the second top, the 22 top, that the market was able to rally all the way back,
right?
Even higher than that, and
even
get
higher
to the all-time high again. I mean, that's the real key differentiator,
right?
Using what I've said earlier and what you learned and what you just described.
Yeah. I mean, forget the left shoulder. The left shoulder is we made a new high. Who cares why? Second one, that high coincided with the Ukraine-Russian war. End of the world. Okay, what's the next high, which is higher than the Russian-Ukraine war? Well, that was the banking crisis. Well, what's worse, the banking crisis or the end of the world? I guess it's the banking crisis, and the banking crisis isn't resolved. And here we are. The point is, the fundamentals are telling you that the technicals are right. That's what I think, anyway. Who knows?
Right. I mean, are we cutting this short today, or is there something else we have to touch
Yeah, we
on?
are. I only have like another 2 minutes.
Cup and handle, or is there something else you want to mention? I could do
cup and handle. Do cup and handle.
Cup and handle in 30 seconds. The reason why this is a super bullish cup and handle pattern is because when you form the cup, it's a very bullish pattern when the right side is a little bit higher than the left side. Now, normally they're at the same level. Now, sometimes you see the right side is a little bit lower than the left side.
You mean the right lip or the right handle?
The right edge. Like if you think about a cup, you have the left peak, and then
the lip of the cup.
Right.
The edge of the cup. Right. Okay.
So
fine. Right.
It's a weaker than normal pattern if the right side is a little bit lower than the left, the first high. Typically they're around the same, give or take.
Right.
When you see the right side that's a little bit higher, that indicates, this is a stronger than normal pattern. And so that's what's happened with gold, where you have the first peak at 1900, the peak in 2020 was 2060, 27, whatever.
Right.
If you're using closing price, pick whatever you want. Now, in addition to that, if you look at a really bullish cup and handle pattern, I'm looking at the retracement from the 2016 low, the bottom of the cup. So
now I should be looking at the monthly, and it looks like the whole cup and pattern goes from right before 2012 to now. And I see what you're talking about now. It slopes higher.
And if you go from the bottom of the cup, which is about 1043, up to the top, which is 2080 or whatever, I'm just doing this quickly.
Right. Yeah, I'm looking at it.
The 38% retracement is around 1685. So in a cup and handle pattern, to be viable, the consolidation should really only retrace 38%. Now, at the absolute maximum, 50%. Like, it's not really like silver is not a cup and handle. I know it looks like it. And look, silver, when it gets up to 50, that's going to be massively bullish. We all know it, but it's actually not a cup and handle right now. I can go into that on the next podcast. But the point is, you look at the handle on this chart, and other than like for a couple weeks, the market is held above the 38% retracement the entire time. So you have two significant indications that this is a very strong cup and handle pattern.
Right.
And people forget, they say, oh, well, it's dead. Well, look, the cup was 9 years. I mean, it can take 3 or 4 years, 2, 3 or 4 years of a handle for the pattern to break out. So you look at all these things and put it together. No, the cup and handle it's very intact. It's a super bullish pattern. It's just taking its time. It's taking a little while longer than I expected, but it's still perfectly fine. I mean, if gold had broken down and fallen below 1700 and be in the 1600s, we'd say, yeah, this cup and handle pattern is busted. And the formation is not bullish until gold has to rally all the way back again. But it's consolidated perfectly. It's held above the 38% retracement, like the vast majority of the time. The right side of the cup is higher than the left. And even this consolidation, most of the time it's been above 1900. So all these things are showing strength. But remember, this is a big picture, like, bird's eye view that we're looking at.
No. I'm looking at it now based on what you said. And so basically the stereotypical cup and handle, the edges or the lips pretty much match. And then you have your handle that comes off of it, like kind of a bull flag, right? But I'm looking at what you're describing now that I understand that is this is a cup and handle that leans to the right higher. And if you were to not look at it as a cup and handle, I'm not saying to not look at it as a cup and handle. I'm just saying, if you were to just say, yeah, this is a cup and handle, but then you look at the handle part, the whole handle, almost the whole handle, except for 3 months, is above the lip on the left, the edge on the left. It's super bullish. It's almost like the 10-month period between, say, August 2011 and December 2012 is support now for this structure. It's not even a lip or an edge. It's a support. It's a base. It's crazy, but that's how it looks to me. I'm biased, obviously.
Yeah, so I'm biased as well, but I just wanted to make that point that there's very strong evidence behind this and that's the problem with a lot of technical analysis is people they look at this is a head and shoulders, or there's specific parameters that fit these patterns that make them those patterns, and that's why therefore the odds of them playing out and breaking out are much, much higher when those parameters are so strong.
Yeah. A message to anyone who's listening who's new to technical analysis, and listen to what this man is saying here. Technical analysis is not a story. Oh, it's a cup and handle. And then you tell a story and you get them to buy some crap that you're selling. No. Technical analysis, the good technical analysis, is a probability engine. If the market does this, the odds of the market doing that are more than 70%, less than 50%. That's good technical analysis. But when you talk about a cup and handle and you don't quantify it, or a head and shoulders, or a vomiting camel, whatever that's a made up one, but that's the whole point. The point is, if you give salesmen a story, they'll sell you bullshit. And I'm telling you, Jordan's the man, right? You need to have a quantification. Technical analysis is a probability engine. Like people will say, like, I'm not a big fan of it, but I respect it. Elliott wave, very subjective, very hard to do, and easily abused by people who aren't even trying to abuse it. But it's like, oh, Elliott wave, it's in a bull, it's in a 3 of 5. Okay, that's cool. But when someone asks you, when someone tells you something, say, what are the chances of this being right? Because all good technical analysts understand probabilities. And that's it. That's what I would like to add to that, because I did not know about the higher edge on the right versus the left. I like that. Now I'm looking at it like an Elliott waver, meaning from the bottom in 2000 and whatever it was, 2016, I'm looking at it like it's a 3 up now. Like I want it to go up. I'm looking at it like a storyteller now. Anyway, that's where we are. Oh, it's been fun. I got to hop though.
All right. Yeah. So we'll wrap this up. If people want to follow you on Twitter and your Substack, subscribe.
Forget Twitter. Forget Twitter. I'm just a shit poster on Twitter. But I do want to mention this. I'm going to give you a link. I started to do this for people that I really enjoy hanging out with. I'm going to give you a link for your people. If they don't want to sign up and pay money, that's fine. But if they do, it'll be 30% off for life for friends of Jordan that come in through here. And that's basically it. If you don't want to do it, fine. But that's fine. You can always hear me talk bullshit when I'm on here with Jordan.
That's great. Well, for people who they don't even have to like me, just say you're my friend, and you'll get the discount.
I hate that guy Jordan, but you know what? I'll take 30% off. It's like, I'm not really a big fan of Donald Trump or Joe Biden, but if I say his name, I get into the club free. All right, I'll vote.
Before we wrap this up, I got a political hot take because I love giving hot takes.
Sure.
I love being contrary. Here's a political hot take for you.
Yeah.
The next president will be neither Trump nor Biden.
Oh yeah, I like that.
I wonder what could you bet on that? I wonder what the odds of that are.
Yeah, I think you go to there's some betting agencies. Ladbrokes is one that most people know. Ladbrokes is an English firm, and I think the way to do that is you take the field.
Yeah. Oh yeah, yeah. I wonder what I wonder what odds you're getting. Like 1 in 10, would you say, or is it even
I have no idea. I have no idea. It changes a lot. I mean, but yeah, I would. But to answer your question, I don't want to bet on the field. To answer your comment, I want to bet against Trump and against Biden. Someone else could win, but it's probably giving you 10% chance. But I think it's probably more like 20%. Trump may not even be running; he may be in jail. Biden, he could be in a hospice for all we know. No disrespect intended to the presidency, but
I had this great hot take before the election that didn't play out. Like my hot take was we could have 4 presidents in like a year. Like this is how it would happen. Like Trump loses, he has to be, he doesn't leave. They have to remove him from office. So then Pence is the second president. Biden comes in, he dies in the first year, then his VP. I was thinking about this at the summer before 20. I was thinking of how just a couple things happened. Like we could have had 4 presidents in 1 year.
Nancy Pelosi would have been in there too.
Yeah.
Right?
Maybe. So yeah, gold about to go into a massive bull market. Just like with what happened in the 70s. I mean, there's we're not going to be having, 8-year presidents in full, But anyway, I'm babbling up, but that's my hot take. Neither one of them will be the next president.
But, I'll take your side of that.
Or will be.
I'll figure out a way to do it.
Neither one of them will be the president after, to make it specific, 24 or January 25. To make it specific.
November is
the next term. Neither one of them will be the president of the next term.
Right.
To be specific.
Right.
But, yeah.
Even if they are elected, they won't be president.
Yeah.
Trump could be elected and go to jail. Biden could be elected and go to a nursing home. We don't know. Anyway, oh God, what a disaster. I was thinking we should do something about that. What you're saying is just the fact that you made that hot take, that crazy hot take, 4 presidents in 1 year. The fact that you're thinking about that now says that we're not stable as a country. I mean, that's banana republic. I mean, you're thinking about it. It's like, hey, I'm thinking about it. Yeah, I never thought about that before. Even when Nixon was impeached, it was like orderly change. Like we're banana republic now. It's pretty scary. Anyway, cool. Thanks for having me on, Jordan.
Goes along with the secular bull market in gold, unfortunately. Yeah. But always a pleasure to have you on. I'll let you go. Yeah, we'll do this again soon. Thanks so much.
Yeah. Thank you, Jordan. Awesome.
Thank you for tuning into the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.